in uncertain times, I really like to listen to analysts who are experts in that particular industry. And right now, the regional banking space is very uncertain. So what I wanted to do was I wanted to highlight an article where they actually interviewed former Peter Lynch colleague David Ellison about what his thoughts are on the regional banking industry overall, and where are some opportunities that he's seeing in the space, as he's still an investor in the space. And so that's what I'm going to dive into in this video. So guys, as you smash that like button, let me run that intro. What's up, guys, and welcome back to the channel. Now, I know that a lot of value investors are not going anywhere near the banking space, and I'm not going to try and convince you guys to go into the banking space. That's not at all what I'm trying to do. In fact, I never make any recommendations on this channel at all. I just try and provide my research and reasoning and logic behind certain things that I'm seeing in the industry or in the market overall. But, you know, the one thing that I always like to do is I always like to go into the spaces where even the value investors aren't touching. So for example, a year, maybe 2 years ago, a lot of the value investors were not going into the housing space. So I found that was very interesting. Another place, especially over the past year, is that a lot of value investors were leaving China, especially where, Alibaba's shares were trading in the high 70s, low 80s. They're still kind of there. And so that's still an interesting space for me as well. And now, of course, the banking sector in the US has opened up some opportunities that I'm seeing, but it looks like I'm not the only one seeing opportunities. And so let's take a look at this article. And so Barron's released this article back in April of 2023, right when the bank issues started kicking off. And so Dave Ellison, he currently works for Hennessy Funds, but he was actually a former colleague of Peter Lynch. And so what he does is he's an expert in the banking space. And so he'll talk about, in this article, he'll talk about banking in general, and then he'll actually list out 3 names that he's investing in. So it's very interesting. I really like to hear from the people who are still in the space. Now, keep in mind, if he was a Peter Lynch colleague, then he's been in the industry for many, many years. And, I'm assuming that he's been in the investments business for more than 40 years at this point. So there's a lot of knowledge and experience that we can gain from him. And so, the first thing that they ask is, you joined Fidelity in 1983, and what are some of your memories of Peter Lynch? And, he goes on to say that, although Peter Lynch was a really good investor, he was even better with working with people and managing people, and he was able to get people to work together with him, which I thought was pretty cool. It was pretty nice for him to say. But diving into the meat of the issue, so they asked him straight up, what problems do you see in the banking sector? And what he's saying is that we don't see much credit deterioration so far. And this is something that I've been talking about a lot on this channel. But what he is saying is that, as rates are going up and bond prices are falling, there is duration risk. So this is essentially what he's talking about is, there's a lot of banks who hold assets that if they're held to maturity, they will provide the appropriate yield and whatever to the bank. However, if there's a deposit flight and the banks have to sell those assets right now, they will be taking large losses on them because the interest rates have run so high. And so what has happened is that if you have an asset with an interest rate of 3% and it's a locked interest rate of 3% and it matures in 2 years, but the rates have gone up to like 6 or 7% for that particular investment security, the only way for the rates for that security to reflect 6 or 7% is that the price of it has to come down to reflect higher interest rates. And so, as time goes on and that security matures, the bank won't take any losses. However, if the bank is forced to sell those as a result of deposits leaving the bank, of course, the bank can run into an issue. And so that's what he means about duration risk. And so, he's saying that, because there's duration risk and there's a bit of a potential recession on the horizon, things are challenging. He's saying that the model is broken, but it's not broken forever. I wouldn't even go that far as to say that the banking model is broken, but I understand what he's trying to say. And so one of the main things that he's going to be watching for is that as costs of deposits accelerate, the net interest margins are expected to decline in the short term. And that's actually something that I mentioned in the previous video. And so he goes on to say, over the next 6 to 9 months, banks will be working through the rate issue. So maybe margins will bottom in the next quarter. I think that they'll actually bottom by the fourth quarter of 2023, but he knows better than I do, and so he actually believes that they're going to bottom in Q2. So that's very interesting. And then, he believes that they're going to start to improve as asset yields start to catch up with the rise in deposits rates or cost of funds. So that's interesting that he said that, because when you listen to the transcripts of the banks, they're actually saying the opposite. They're saying that the asset yields have accelerated faster than the cost of deposits coming up. And so I will, take the approach that I think that the banks are right, but it's interesting how he said that it's going to be happening in the opposite way. But okay, so what that does is it could lead to a noticeable increase in non-performing loans. And because, if the interest rates are higher, then of course they may enter into a situation where they may not be able to service that debt. And so, he is seeing that the numbers for the non-performing loans are starting to move higher. I'm also seeing that, but we both agree that the credit that we're seeing that is deteriorating is happening very slowly. Loan growth also isn't that good. I'm definitely seeing that too, and the earnings aren't growing. So the real issue here is to not focus on the next year's expected earnings or the subsequent year's expected earnings. I think because of this situation, the real issue is, and in order to find the right opportunity, is to focus on what the long-term income generating capabilities of that bank are, and value your opportunity relative to that. And I'll show you guys in this video how to do that. And so all of those issues, he's believing will create a buying opportunity that's ahead of us in bank stocks. And I absolutely agree with it. I've seen that happen. And as a result, banks are, I think, my second largest position in the portfolio now. Once again, that's not telling you guys to invest in banks. In fact, I would suggest that if you're new to investing, you stay away from banks, insurance companies, and other sorts of financial businesses as a whole, because they are complicated and difficult to understand. And so, he is believing that banks have fundamental headwinds. However, they aren't life-threatening headwinds. I agree with that. And he's saying that they are just earnings threatening to some degree, and they are valuation threatening. So he's effectively saying that these things aren't going to go out of business. They're not going bankrupt. I mean, there might be some that go bankrupt, but it's difficult to tell. And so you really have to look for tells. And any of the banks that I've sort of been putting my assets into, I see a very strong likelihood that they will survive this. And so, it's just an earnings issue. And if it's just an earnings issue, that's fine. We can weather 2, 3, 4 years of challenged earnings, especially if you're underwriting, or not necessarily underwriting, but especially if you're pricing your investment and you're doing your analysis on a much lower return figure than what the bank is expected to generate in 2023. And so he goes on to state that there's 3 banks that he really likes. The first one is Citizens Financial Group. The second one's M&T Bank, and the third one is Webster's. Now, M&T Bank actually is a bank that previously Berkshire Hathaway owned. Citizens Financial, this is one that I just started learning about this year, and Webster, same thing. Now, the one thing I want to point out is that all 3 of those banks mentioned are on the tracker that I've built for the Patreons at the higher level. You can see M&T Bank right there. And what this does is I've actually analyzed 63 national and regional banks using key performance risk indicators, not RIC indicators, but risk indicators that you can see up above here. And, what this tracker does is it scores those banks against one another, and then the highest scoring banks are the ones that I dig into and I do further research to determine if it's worth investing in. And some of the guys that got hit the hardest over the past month are on here as well. So you can see Comerica is here, and that was one that got nailed pretty, its share prices came down pretty heavily, despite the fact that it doesn't look like that company was going to go out of business either. And so I will be going through the comps tracker in this video to analyze Citizens Financial. And so if you guys do want to follow along, the comps tracker is available on this tier. Here it is right here. But the other thing you get access to is the special live courses and the monthly calls. And so join over 200 Patreons if you want to join us on the Patreon. And one other quick thing is when you get access to that Patreon, there's also a 2.5-hour live regional bank analysis course where I review the key performance indicators for banks. I apply those to the banks that we analyze, and then I provide my personal ranking for the banks analyzed. Now that ranking has changed now, but it's a good learning workflow, this course is, and so I highly encourage you guys to take a look at it. And so let's jump right into the bank that he mentioned first, which is Citizens Financial Group. This one was very interesting to me because I've never done work on it. And so he's saying that it's trading at around 6.5 times next year's earnings, and it's expected to earn $4.50 per share. So what is the equity yield on that? Well, $4.50 divided by 28 is 16%. But I would say, don't get fooled. This is an unsustainable high equity yield. He has just told you that earnings are going to start getting squeezed, right? And maybe the company will earn $4.50 a share, or maybe those expected earnings are going to get revised downwards. And so, I would say use the company's average annual return on tangible equity to price this. So for example, if the company's book value today is $29 per share, and the company on average earns 13% on tangible book, then the average earnings capability, if you multiply those two numbers, is not 4.5, it's 3.77. And then if you divide 3.77 divided by the 28, you get a 13.5% equity yield, not 16. And I would price it based on that and tell myself that, if I want a 15% equity yield on 3.77, I would take the 3.77 divided by 15%, and I would be looking for an entry price of $25 per share on this opportunity. And so $28 per share is not a great opportunity, or not a good price in the current environment. So that's kind of how I think about it, but you guys let me know how you guys are thinking about it and how you guys are trying to price this. But basically, I'm being very conservative in this environment because I expect the NIMs to come down. I expect losses to increase slightly, and so I expect the provisions to go up as well, which of course impacts your net income per share. And so, he's saying that their net interest margin was stable in the first quarter at 3.3% versus the prior quarter, and I'll show you that. And it's been pretty stable over the past few quarters, which is fine, but that doesn't necessarily mean that it's going to be stable going forward, and I'll explain why. So here's the tracker, and I just highlighted Citizens Financial Group on the tracker. Notice that it actually scored 3 out of 10 on the scoring system. And so the bank does not score high on the impartial scoring system. It's just a 3 out of 10. But don't be fooled. A low score on the tracker doesn't necessarily mean that the bank isn't strong. The scores are just there to sort of tilt you into determining which banks to do more research on, because it takes a lot of time to research these banks. You got to go through all their disclosures and stuff. So it just is a shortcut, but that doesn't necessarily mean that a low scoring bank is not worth taking a look into. And so you can see that they're trading at around 7.6 times price to their average earnings generation capability, which is of course lower than what they're expected to earn in 2023. They have an average tangible ROE divided by price to book of 13.1%. So really what that's telling you is that the average tangible ROE is lower than that 16% that you are expecting to earn next year. And I think really it's 12.4. So 12.4 divided by this 0.94 gives you the 13.1. It's somewhere around there, and that's how you're getting to that 13.1. So don't be fooled by what the company's going to earn next year. Focus on pricing it based on what the company's capable of earning over the long term on their book. And let's get into that a little bit more. So I hope you can see this, but this is exactly what the tracker will look like for each of the opportunities. And so you can see that, anything that's highlighted green is where they are, I would say, where they show better or they show very well relative to competing banks. And so that's why it's 3. So you can see 1, 2, 3. So they show well on net interest margin. They show well on efficiency ratio. Anything under 60% is a good efficiency ratio in my opinion. And then they also are a well-capitalized bank. And so here you can see the tangible ROE average 12.4. That means over the last 5 years, they averaged a tangible return on equity of 12.4%. And so the next thing that I would do in this is open this up and see if that 12.4 actually makes sense. So here it is. You can see that in 2017, they earned 12.4, and then thereafter, they're kind of in that 12% range. 2020 was a disruptive year, and so was 2021 to an extent. And it looks like they're going back to their average, which is around that 12%. Look, it could be less than that. It could be more than that. The better thing that you should do is actually open this up and pull in information from, 10, 15, even 20 years if you can, to see what their very long-term tangible return on equity is, and then find a number that you're comfortable with. But I'm comfortable with the 12.4. I think they'll kind of stick to that. So I think the 12.4 makes sense. And so before we go any further, let's level set for a second. So how do I analyze regional banks? Well, the first thing I do is I look for banks that score high on the 10 operational measures compared to their peers. And that's what you guys just saw me look at on the comp schedule, where I showed you that Citizens Financial only has a 3 out of 10 score. That doesn't necessarily mean that it's bad, but once again, but I do start with analyzing the banks that have the higher scores, and eventually I'll analyze all 63 or most of them at least, but that's kind of the way I'm doing it. Step 2 is once I find some strongly scoring banks, I look at their average return on tangible equity and ask myself if it's reasonable that they will repeat that performance in the future. I just did that with you guys with Citizens Financial, and I think that 12.4% is reasonable. And so if the answer is yes, I'll divide that with the current price to book to arrive at an equity yield. And I did that with you guys too. So that 0.124 divided by 0.94, because they're trading, their current share price is at 94% of their tangible book value. And so if you take that 12.4 and you divide it by that 0.94, you're getting a return on tangible equity divided by their average price to book of 13.1 or 13.2%. And really what that's telling you is that if you wanted to start the bank today, like start a competing bank, you would have to start it at book value. You can't start a bank under book value because you got to pay for starting everything up. Or you can buy a bank for under book value. That's really what it's saying. And so if you can buy a bank for under book value, its book is still going to generate that return. And so you just have a higher return because you paid less for the bank than what its book value is. Now, part of the reason why the bank is trading at a lower book value, or at a price that's lower than its book value, is because people believe that that book might be overvalued, and if they take on some losses, the book value could come down, or if they take on some losses with their investments as well, so not necessarily their loans, with their investments as well, it could bring the book value down. I just don't think that it's going to be material over the long term. And so once I find a few strong companies with a return on tangible equity divided by their average price to book greater than 12.5%, I do a deep dive into their financial statements and their disclosures, and I'm looking to answer the following. What makes them different? What are their risks? What's their long-term track record? And how have they performed in the past downturns? And specifically in this environment, I'm looking to answer these two questions. What is the loan portfolio risk? And what is the deposit base flight risk? And so let's get into that. So every bank has this type of chart in their financials, and so just dive into the 10Ks and you'll find this. And so the first thing I'm looking for is how much commercial real estate exposure do they have. So you can see right here, I've highlighted 14% of their overall total loans and leases are commercial real estate. So this tells you that commercial real estate exposure exists and it looks high on surface value. But here's the pro tip. Not all commercial real estate is the same. This is where the finance media will try and mislead you. You always have to dig into the type of commercial real estate exposure that the bank has. This takes time and most won't do it, but this is where you'll find the hidden gem. So essentially what I'm doing is I see 14% commercial real estate exposure. A lot of investors will stop right here. They'll say, look, it's got too much commercial real estate exposure. I want a bank that doesn't have a lot of commercial real estate exposure. And so they'll write off Citizens Financial. I'm telling you guys to take a deeper dive, and this is what I mean. So commercial real estate could be anything, like a church, a multifamily home, a hotel, et cetera, et cetera. And, the area that seems to be in most risk right now is office real estate. So you want to see how much of their commercial real estate exposure is office REITs or office real estate. And so you can see that when you break out their commercial real estate, you can see that only 4% of their total loan portfolio is office real estate. That's the risk. I think some of these others are not necessarily as high of a risk in this environment. And so, with 4% of your total loan portfolio being office commercial real estate, it tells me that I'm not very concerned about your commercial real estate risk, as I feel as though you are very, very diversified. Now, in their Q1 investor deck, they actually broke down their commercial real estate exposure even more. So they break down that 6.3 million into two groups. They show the office credit life and they show it as office general. And so office general is where I would expect more the risk to be in. And so what they're telling you is that they're continuing to build a reserve position, reflective of their risks in their general office portfolio. And so right now they've reserved 6.7% of the portfolio. And so I even say it here where like they've provided for 6.7% of the portfolio, which seems a little bit excessive, but I'm not mad at it. But the other thing is their office general portfolio has an average loan to value of 60%. And so that tells you that there's a lot of safety in this portfolio overall. And I believe that this 6.7% provision is probably more than enough. And then they break out their commercial real estate office portfolio more. So like this is great. Like I think one of the things that I really like about their disclosures, and I'll actually email them and let them know like they've done a great job with their investor relations team on providing this information to us. But of that 6.3, that's the area that I wanted to hone in most, and it's phenomenal that they've been able to break it out. But they're telling us right here that of that 6.3, remember that there was that 4.1 billion of general office, and then they break it down even further to us. So they're telling us that of that 4.1, 64% is real general office. And of it, you can see how it's very geographically diversified. But the most important part is the fact that 90% of it is income producing. That tells you that it's leased up, so you're not going to get a significant amount of challenges there, at least over the short term. Where you could potentially run into risks is your construction lending and with some of your REITs as well. But I don't think if these REITs are leased up, which I believe that they are, that's probably not the risk. It's just in the construction side where you could see some risk. But here's the problem. Or here's the situation. Construction tends to build the newest and best amenity type properties for office. And so these would be your class A's. I don't think your class A's are going to have a challenge filling up. I think what's going to have a challenge filling up is your class B's, which are like 30 or 40 years old. Now, here's the problem. They have a lot of class B exposure. So I think what they're doing is they're going through their portfolio. They're looking at which of their class B and class C properties may have challenges keeping tenants, and they're provisioning against those. And so if there's any risk, it could be in here. But once again, I do believe that their provision more than makes up for it. The loan to value being 60% is great. Now, some people can argue that the loan to values are a fugazi number. They could come down substantially like we've seen in San Francisco. Maybe, but then look at their geographic diversification. So it's not that they're overly exposed to the San Francisco or the Manhattan market, right? And so the fact that they have a 60% loan to value plus 90% of the properties income producing, I think you're fine. But of course, nothing's ever certain, so don't take my word for it. Always do your own due diligence, and do not take anything that I say on this channel as a recommendation to buy a security. You should just take this as my opinion on how I'm describing what I'm seeing with the research. And so moving on to the deposit flight risk, you can see that their loans to deposits have been tweaking up a little bit. So 90% right now. So that's not worrying, but at the same time, I'd love to see this under 80%, maybe under 85%, kind of where they've been at previously, or at least where they were last year. So, this is something that I'm going to continue to watch. But, the analyst did say earlier on in the video that their net interest margin actually held. And, it's interesting. It actually went up year over year. And this is what I mean. The interest rates have gone up faster than the cost of deposits have gone up, but I think this trend reverses thereafter, and so I do believe that the net interest margin is going to return back to its normal levels, which for them it could be closer to 3%. Now, when it comes to deposits, I just want to see a large amount of consumer deposits, a large amount of insured deposits, and that's exactly what they show us here. So once again, kudos to the investor relations team. They provide really good disclosures, and so I see little risk of deposit flight due to significant majority of the deposits being insured at 67%, and the total number of deposits are at 68%. Notice there's just a huge mix between their deposits as well, and so I think they are stickier than people would assume. But the one thing that I do want to point out is that as interest rates continue to go up, you might see more of these demand deposits move into sort of like these savings or checking. So that's where I feel as though their net interest margins could come down. So this is not a deposit flight issue. This will more just be a profitability issue, at least in my opinion. I'm not concerned with deposit flight for this company at all. And so let's talk about that net interest margin. So you can see that their funding costs have been going up, right? And so, their asset yields held strong. So their asset yields went up by 0.44% to offset the raise in their funding costs. However, I do believe that the asset yields are going to top off and the funding costs are going to continue to go up. And so, they've been able to keep it stable, but I expect deposit costs to rise slightly faster than interest income throughout 2023. So the NIM, I believe, will be pressured. However, the question is, so what? And that's the right question. And I do believe that it'll level off in time. And the way to sort of think about this is, don't price this opportunity at what analysts are expecting it to earn in 2023 or 2024 or 2025. Price it based on the average income generating capability of the book, which is lower at that 12.4% as opposed to the 16% that a lot of people are looking at. And it's the same number. That 16% is what the analyst spoke to earlier in this video as well. But if you're a long-term owner of the security, you can't price it based on that 16%. You'll get disappointed in the future. Maybe 5 years from now, you'll get disappointed. I think you'll get disappointed much sooner than that, though. And what exactly am I blabbering about? Well, here's what I'm talking about. This is what the analysts expect, right? And if you just take the 4.43 and you divide it by the current share price, you're getting a 16% yield. So, although I do agree with the street that the next few years of results will probably be pretty stable, you probably will get that 16% equity yield, but long term, I expect something closer to that 13% equity yield. And so I am going to pretend like this doesn't exist. And instead, I'm going to do that 12.4 times, I don't know, what was the book value? It was something around 29. And so, $3.60 per share is what this thing generates. And so divide that by 15%. I'm looking to buy this under $25 per share just to be overly conservative in this environment. There's a couple of ways I can do that. I can sell options, like I can sell cash secured puts, or I can buy the shares and immediately sell a covered call just to make sure that my cost basis is lower. Obviously, I mute my upside on that, but I'm the type of investor that focuses more on downside than I focus on upside. And there's nothing wrong with getting rich slow. I tend to do between around 12 and 17% a year, and that's more than enough. I don't need to be doing more than that. And so once again, guys, if analyzing regional banks is something that's new to you, the course can help you. And so, remember, guys, that we talk about the key performance indicators for banks. We do a really good review of those, actually, and then we apply those key performance indicators to the banks as we analyze them, and then I provide my ranking and why. Once again, guys, my ranking banking has changed, but this is still a very, very good learning opportunity for you guys. The 2-hour and 30-minute course that you get in conjunction with everything else at that top tier. And once again, these are the tiers. So at the top, at the lower tier, you get access to the tracker, like my securities tracker. And so, you know, it's a very strong value. But at the higher tier, you get access to all the monthly live calls, the live courses, and the comps schedule. And so join over 200 Patreons in supporting this channel. And so I'll leave it there for you guys. Let me know what you think. Are you guys leaning more towards looking at banks, or what other industries are you guys kind of looking at in this environment? Let me know in the comments below. I'll try and respond to every single one of you. And so I'll pause it there. And if you haven't seen my last video where I started talking about banks and investing in them, you can actually get to that video right here.